You walk into your bank, deposit your hard-earned money into a savings account, and walk out thinking your money is safe and growing. But what if I told you your bank might be profiting way more from your savings than you aren't there? Not exactly shouting about it, there's a silent game being played with your money, and unless you understand the rules, you're the one losing. So, today, we're going to uncover what your bank doesn't tell you about your savings account, and why it matters more than you think. Let's dive in. Number 1. Your interest. Rate is barely moving by design. Banks love to advertise their high-yield savings accounts, but let's be real. Most traditional savings accounts pay you less than 1% in interest. While inflation eats away your money at a much faster rate, according to the U.S. Bureau of Labor Statistics, average inflation over the past few decades has been around 2 to 3% per year. That means if your bank pays you 0.5%, you're effectively losing purchasing power. Here's an example. If you save $10,000 at 0.5% interest for a year, you'd earn $50. But if inflation was 3% that year, your money's buying power actually shrunk by around $300. You gained a tiny 50, but lost a real 300. Number 2. Banks use your money to make big profits while you earn pennies on your savings. Banks lend your money out to others at much higher interest rates. Ever wondered how banks make billions in profit every year? They borrow from you at 0.5%, then lend that same money out in mortgages at 6%, auto loans at 8%, and credit cards at over 20%. So while your $10,000 sits quietly in a savings account, the bank might be making $600 to $2,000 or more from it annually. And how much do you get? $50? Maybe. Number 3. Compound interest takes forever at low rates. We've all heard that compound interest is powerful, and it is. But at super low interest rates, it becomes almost useless for short-term goals. Want to double your money using compound interest? At 0.5% interest? That would take roughly 140 years? Yes, you heard that right. 140 years now. Compare that to an investment account with an average return of 7%. There, your money could double in just about 10 years. Number 4. Fees. Can eat into your savings even if you're not spending. Many savings accounts come with minimum balance requirements or monthly maintenance fees. If your balance dips below a certain amount, the bank might charge you $5 or $10 per month. Doesn't sound like much. That's $60 to $120 per year, more than most people earn in interest. For example, say your savings earned you $40 in interest this year, but your account charged you $5 every month. That's $60 in fees. You actually lost $20. Number 5. Not all savings accounts are FDIC insured. This one surprises people. Most traditional savings accounts are FDIC insured, which means if the bank collapses, your money up to $250,000 is protected by the government. But some newer fintech or online savings platforms may not be FDIC members. If you don't double-check, your money might not be protected in the event of a failure. Imagine saving for years, then one morning waking up to find your platform shut down, and your money is just gone. Number 6. Your bank might be slowing down. Transfers on purpose. Have you ever noticed it takes a couple of days to transfer money from savings to checking? That's not always a tech issue. Sometimes banks intentionally slow transfers, giving themselves more time to use your money before handing it back to you. It's called float time. It's one of the oldest tricks in the book. Every hour your money isn't in your hands, it's in theirs working for them. Number 7. High-yield accounts exist, but they hide them some. Online banks or credit unions offer savings accounts with significantly better interest rates. It's like 3% or even 4%. But your traditional bank probably won't mention these options. They don't want to lose your cheap money. They want to pay you the bare minimum while maximizing their margins. Unless you go searching and comparing rates yourself, you'd never know there were better options out there. Number 8. Your savings might be taxable. Many people assume their savings account is tax-free. It's not. Any interest you earn from your savings? No matter how small is considered taxable income by the IRS. So if you earn $50 in interest, you'll have to report that when you file your taxes. The twist? That same interest may push up your adjusted gross income just enough to reduce your eligibility for certain tax credits. So yes, your free money could end up costing you more in the long run. Number 9. Savings alone won't build wealth. Say you save $200 every month in a basic savings account that earns 0.5%. After 10 years, you'd have saved around $24,000 and earned maybe $700 in interest. Now compare that to investing that same $200 per month in a low-cost index fund earning 7% annually. After 10 years, you'd have closer to $34,000. The difference? About $10,000. Saving is important, but investing is what helps your money grow. Number 10. Banks. Count on you being passive. Here's the big secret. Banks are built on the idea that most people won't ask questions. They count on you not moving your money, not comparing rates, not learning the real math behind your account. The longer you stay passive, the more they profit. But when you become an active participant in your finances, asking questions, reading the fine print, exploring smarter options, you flip the script. Number 11. You have better options in banks. Hope you don't notice there are better places to park your cash, like high-yield online savings accounts, credit unions, money market accounts, or even U.S. Treasury-backed I-bonds, which have historically paid more than inflation during certain periods. One example. An online savings platform recently offered 4.35% interest compared to 0.01% at some national banks on a balance of $10,000. That's $435 per year instead of $1. Same money. It's a very different outcome. Number 12. Auto-saving apps are outsmarting traditional banks' newer fintech apps. I use behavioral psychology to help people save more automatically. They round up purchases, analyze spending patterns, and transfer small amounts to savings when you're unlikely to notice. These apps are disrupting old-school banking, and in many cases, they offer better returns or easier access than traditional savings accounts, but banks don't want you using them. Why? Because they don't get to control or profit from that money. Number 13. Loyalty.
Out.
Doesn't pay switching often does? You might feel emotionally attached to your bank because you've had your account since high school? But loyalty rarely pays off in banking. Many banks reserve their best. Offers like sign-up bonuses or higher interest rates for new customers only. That means switching banks could make you hundreds of dollars richer. One real-world example. A major bank offered a $300 bonus. It's just for opening a new savings account and keeping a certain balance for 90 days. If your current bank has never given you that kind of love, maybe it's time to move on. Number 14. Saving in a silo won't help you reach your goals. A savings account is great for an emergency fund or short-term goals. But if you're saving without a strategy, your money just sits there missing out on potential growth or purpose. Break your savings into buckets. Emergency fund, vacation fund, car repair fund, investment fund. Give each dollar a job. When your money has direction, it starts to work for you, not just wait around. Number 15. They don't teach you any of this on purpose. Here's the truth. Most of us were never taught this stuff in school. And the banks are not exactly in a rush to educate us either. Why would they be? A confused customer is a profitable one. But now that you know what's really going on, you're no longer confused. You're informed. You're empowered. And that changes everything. So now the question is, what are you going to do with this information? Are you going to let your money sit and shrink, or are you ready to take control, move it smarter, and finally make it grow? Which one of these savings secrets shocked you the most? Drop your thoughts in the comments.